ladies and gentlemen. Welcome to the Money Mentor podcast with your host, Graeme Holm, aka Australia's original money mentor. And again, we have the amazing Dr. Andrew Wilson. Now, again, in case this is your first time and you've been living under a rock, Dr. Andrew Wilson is Australia's leading independent property economist, and independent is the key word. His information and his advice and knowledge and data is not skewed towards any bank agenda, government agenda, any particular organisation. I say again, independent leading economist. Now, who is Doc? What has he done? He's currently the chief economist of My Housing Market, previously chief economist of Domain Group, and a whole heap of other very well-respected organisations. Qualifications-wise, why do you need to stay tuned? Well, most of you know, but if you're not aware, Dr. Andrew Wilson holds a Doctor of Philosophy in Housing Market Economics from RMIT University, Master of Science by Research, RMIT University, Graduate Diploma in Economics, Monash University, Bachelor of Construction Economics with a distinction. He's a smart cookie, RMIT University. He's also a member of the Royal Institute of Chartered Surveyors. So I'll leave it there, because if you add all those letters up when you start going PhD, MSc, grad, he's got more letters after his name than I have in my legal 3 birth names. So good morning, Doc. How are you?
Yes, good, Graeme. It's been another big week in property and maybe a very big week in property because, of course, we've had the announcement, perhaps a shock announcement, that interest rates will only rise by 0.25% this month. I think everybody was expecting another 0.5% interest rate increase.
I don't know, Doc, was it a shock to us? We kept saying every increase we were closer to normalising, and I think you've been saying it for probably a month or two now.
Well, I think we've been discussing that perhaps we're going to get to the peak of our interest rate cycle a little sooner and a little later than has been forecast. And this, of course, is the first sign that is occurring. I think there was only one sort of notable forecaster who forecast that 0.25% increase, and that was the Commonwealth Bank. And, I'm not sure how they got that right when everybody else got it wrong, but I've got a suspicious mind, but I won't take it any further. But certainly most were expecting that 0.5% increase, and we only got 0.25%. And I think the important thing here, Graeme, is that it's really unlikely to bounce back up to 0.5% from here. It would actually tend to make the Reserve Bank look a little flaky in a sense. Now, of course, if the data that comes out over the next few weeks, and that, of course, is the inflation data, if that's a bit of a shocker, I guess they'll be forced to go back to the 0.5%. But I'd suggest that this is obviously a clear sign that they've felt, okay, we're going to move forward a little lower from now on. We don't want to be throwing out the baby with the bathwater. We don't want to be crunching the economy. We don't want to be heading into the sort of environment that the US and the UK are, where they have certainly higher interest rates and higher inflation than we do. And perhaps, all kudos to the Reserve Bank at doing their own thing here. Perhaps they're pretty reasonably happy that our economy is performing okay. Yes, inflation is an issue, but perhaps they think they can get that under control. And maybe some of those forward indicators are giving them more confidence, such as the price of oil falling particularly. But I think it was a little bit of a shock. And I think a lot of the media were taken a bit aback by it. They were still trying to talk down the positives of it all, and it was all doom and gloom. It was like, oh, interest rates have increased. Yeah, but it's only by 0.25% sort of thing. And I think that is a bit of
took a bit of the sting out of the clickbait yesterday, didn't it?
Right, a little bit. It was like, I think people were thinking, well, that's all right, 0.25%, not another 0.5%. So it's actually half what we've had over the past 3 months as an increase. And as I said, we'll get the inflation data out this week. Not this week, but this month, in the next couple of weeks. The Reserve Bank is now releasing monthly inflation data at long last. And it did provide us some forward estimates or its first monthly estimates of inflation last week. And those numbers for July and August were perhaps a little higher than I would have expected, but I don't think they really give us anything, because once we move into the monthly numbers, well, who cares about, 2 months or 3 months before? It's all about the latest monthly numbers. And we know that the price of oil has fallen sharply. So that will certainly should act to reduce the inflation rate over September.
Well, that's a funny one, Doc. I put a post up on socials the other night, and there was people lining up for kilometres around the block I worked out roughly to save $12 to $16 for a tank of petrol, right? Before the fuel excise was cut. Yeah. Yet they spend $30 a day on coffee and takeaway instead of making their own lunch, but they'll line up for 4 hours to save $12.
Yeah, and how much petrol are you using while you're idling away there, waiting?
Yeah, the aircon on and the radio. So I wanted to just start a little bit and talk about that with you this morning, because I guess mainstream media have to play a part in this. Like, we're almost brainwashed into thinking what we should and shouldn't do somewhat, right?
Yeah.
I guess what's going on with the psychology of the economy for people, do you think?
Well, I think it's a question now of that we're all getting on with business. When you talk about the media, it's a bit about the chicken and the egg. I mean, if people just ignored all the gloomy, doomy headlines and got on with things, while the media wouldn't get the clickbait that it's looking for, and they have to look for other stories and maybe more realistic stories. But the point is that we do respond to the clickbait. That's why it's called clickbait. And as long as that happens, of course, you can't blame the media. If they're attracting attention, they will attract attention. Media are not doing well, Graeme. They haven't done well for quite some time now. And they need to get all the eyeballs that they can on their product. And if that means, doom and gloom and scary stuff, well, so be it. It's not their responsibility. Their responsibility is to make profits, and they only make profits when people are viewing what they're presenting. And, that's the whole point. I guess the clickbaiting really is about looking at those that do make these particular pronouncements in terms of doom and gloom and hold them accountable to some degree for what they do say. But that doesn't happen anyway. And I think that's because our attention span is a little limited as well. We sort of get on. But I do think Australians are getting on with business, Graeme. We had some very positive results in terms of house prices over September. Prices, yes, are still falling in Melbourne and Sydney. In fact, they're falling everywhere, but the rate of decline is now clearly easing. And as we've discussed over the last month, we can really get a little bit more substance to that proposition we've been making, that maybe we're heading for the bottom of the market this year in Sydney and Melbourne. And we may flatten out by the end of the year over that December quarter, Graeme. And it's not just the house price data that's supporting that proposition. We're also seeing other indicators of housing market activity also improving. Days on market, that's the average time a property is on the market, have fallen over 2 consecutive months in Melbourne and Sydney. So it's taking a little less time to sell your property in Melbourne and Sydney compared to a couple of months ago. And auction clearance rates have really been the story. I mean, we focus a lot on auction clearance rates, Graeme, and maybe we can look at last weekend's results. But
yeah, let's have a look at last week's national clearance rate stock.
Well, it was another distracted weekend, of course, Graeme. Long weekend holidays around the place. Sydney and Canberra had very low numbers of auctions because of those long weekend distractions. Quite a reasonable result for Sydney. Usually holiday weekends, you can take your pick as far as the clearance rate goes. But with low volumes, it's not necessarily you're going to get a strong clearance rate. Particularly, it tends to be the mid to higher price properties that aren't engaged over holiday periods, right? But we've still got a clearance rate just above 60%. But when the market resumes over the next couple of weekends, with even though we're getting back to school, we'll get a feel again for the strength of the Sydney market, which has really been holding up quite nicely. And we can see there that the Melbourne market, it was back at full strength after its pause the previous weekend for the AFL Grand Final. Again, a mid-60s clearance rate in Melbourne, just below the weekend before. Adelaide...
And vice versa, Doc. So we had NRL Grand Final, traditionally a Sydney, Queensland, New South Wales thing. So they had low numbers. They dropped from like 700 the previous weekend down to the 200s and still cleared above 60, where we had AFL Grand Final in Melbourne the week before. We had about 97 auctions that cleared at 65 odd percent. But then Melbourne's come back strong with like 700 plus and still cleared at 63 and a bit percent this weekend.
these are positive results. And it's not just the clearance rate, it's the number of properties coming into the market, Graeme. I don't think these are, sellers that are panicking and getting their market, getting into the market as soon as they can. I think that, buyers and sellers are shrugging off all the negativity. I think they'll be feeling a lot better about that interest rate increase, and they're getting on with business. And I think that largely the, forecasters of doom have ignored the fact that we've got one of our strongest economies ever at the moment. This unemployment rate is spectacularly low. Wages are rising. Everybody's got a job who wants a job, more or less. And bosses are all over their workers trying to give them more money to keep them in their jobs, So it's a great time in that sense for workers. And I think if you're earning more money and you're feeling in demand in your workplace, you're looking at the job ads and thinking, hey, I could get an extra 10 grand or 20 grand here. And maybe you do get that extra 10 or 20 grand. You start thinking about, hey, maybe it's time to take advantage of lower prices at the moment, get into the market, and move on with my life. What's the point of having a great job and a great income and increasing income if you can't take advantage of it, particularly in a market that's still a little bit sideways in terms of prices growth? And I think that's the momentum that will start to build. And we're seeing early days of that momentum starting to build in Melbourne and Sydney, Graeme. So, auction clearance rates holding up, days on market are falling, and, the decline in prices is starting to ease as well. So, these are all, again, supporting our proposition that particularly the markets that headed down the first, and that was Melbourne and Sydney, are going to start stabilising the first, and maybe as early as the December quarter, which is the quarter we're in at the moment.
And interestingly enough, Doc, we've both said over the last probably 3 or 4 weeks, at least even longer actually, that we probably think that this correction we're fearing from interest rate rises isn't as deep or as steep is the terminology we've both been using. And you're right, we are seeing that. I mean, looking at your data set this week, I was having a look at the median asking prices each day. And I mean, I looked at Sydney and went, geez, it's not really moving at all. It's pretty
That's
much
right.
bang on week.
That's right.
And
Yeah.
Melbourne's staying strong as well. So it's interesting. It's not like people are heavily the vendors and sellers, they're not heavily discounting their properties. The ones that are prepared to sell are selling. And there's buyers out there buying. Like you said, they're just getting on with it.
And as I said, this is the strong economy at work, Graeme. People have, we've discussed how, consumers are in a strong position, at least to counter higher interest rates in the short term. High savings rate, full employment, wages are rising. Their assets have grown spectacularly over the last 4 years, even though they're easing now. So, it's not scary stuff. And I've got a couple of slides there which show us the quarterly auction clearance rates, Graeme. And I think they're very instructive because they show us, if we compare where we are now to 2018 with those trend clearance rates, these are quarterly clearance rates up until the September quarter. We know that 2018 was a similar period and into 2019 to what we have now. We had low consumer confidence. There were, crazy predictions. Prices were going to fall by 40%, et cetera. And people, buyers and sellers sat on their hands at the end of 2018 and into 2019. And if you look at clearance rates during that period, Graeme, you can see how low auction clearance rates actually were in 2018 in both Sydney and Melbourne compared to where they are now. And that's the whole point. We're in a market which has got fragile confidence because of higher rates and a lot of those negative headlines, but our clearance rates have actually held up, and they've held up at a significantly higher level than they did in the previous doom and gloom period, notwithstanding COVID, of course, which was a different set of circumstances. But certainly when we look at 2018, auction markets are continuing to perform reasonably well, certainly a lot better than they did 4 years ago, Graeme.
And Doc, it's interesting looking at those slides you're referencing there that the viewers can see at home. When you look at those dips in 2018, but the median's actually quite strong, because you said this a couple of weeks ago on the podcast. You said, Graeme, the rate at which properties subdue and decline during interest rate rise fear, they actually statistically grow out of that when we normalize that. I think you quoted 4 or 5 times in some cases. You said they exponentially grow compared to what they settle.
And that's because during the negative periods, Graeme, people obviously, buyers and sellers sit on their hands. We call it phobia, fear of being involved, because, they're thinking, well, I'm just going to wait and see what happens here. It's all pretty scary stuff. Not good, all these predictions of house price crashes. So during these periods, we see the market move into pause mode. And of course, as soon as the air starts to clear, we start to see buyers and sellers thinking, hey, things aren't that bad here. Oh, gee, that's pretty cheap, that property up the road. I'm going to get hold of that before, price. And then it builds the momentum. And before you know it, you're back into FOMO with fear of missing out generating the market.
Well, I was going to say, Doc, that pent-up demand, I'm just looking at all of the graphs here from your data, and it's like every time there's that little 5 or 6% correction or 4%, then it grows 10, 12, 20%. Then a few, there might be a little 3 or 4, and then it grows 12, 15% again. So you're right, there's that fear of being involved temporarily, but then there's the FOMO. It's like, hang on a minute, whoa, I'm going to miss out. I won't be able to afford this.
Yeah, that's right. And maybe FOMO will start re-emerging late this year or early next year, because I said this is a very shallow environment at the moment. The quarterly price declines were steep, but we've got to put that all in the context that over the past 4 years, even with these steep declines over the past quarter, house prices are, have driven by 8 to 10% per year, including those declines over the past 4 years, Graeme. So people are thinking, okay, it's a paper number, it's just okay, it's worth a little bit less, but gee whiz, it's worth so much more than it was 4 years ago. And we're in this booming economy, which makes everybody feel good. It's like the reality is, if you've got your job, right, you're getting a great pay rise, and you feel secure, Graeme. You're not. The worst thing can happen to consumers is if they lose their income, or if they're under real pressure to match their expenditure. Now, that can happen, of course, as inflation rises, but we've still got those offsets to inflation, higher inflation. And, those factors such as the price of oil are starting to improve now. So our daily sense of having to pay more for fill up the tank, is, not a significant downer for us in terms of getting on with our life. And I think that's what we're seeing now. But, it is interesting. And as you said, when we look at the slides for asking prices, daily asking prices, they've really continued to be quite flat going forward for both houses and units. There's no real sense over the past month that there's a decline in that. But we're also going to release I'm not sure we want to discuss that today, Graeme, but we've released our rental report as well for September. And unfortunately, not a lot of great news, I guess we're not surprised for tenants in terms of what's happening in the rental market. Rental prices are still certainly high. Sydney's averaged 650, or its median rent was 650 for a house over September. But if we look at the latest daily data, the Sydney rent's at 660 now. So we had a pause for about a month with Sydney house rents, and now they're starting to look like they're tracking up again. And I just think that's because tenants just couldn't pay the rents that were being asked. So they've had to save a little bit more perhaps, but now, they have no choice but to pay those higher rents. But there's no doubt that we're still seeing significant upward pressure on rents for both houses and units, particularly units. And I think, as we've discussed, the growth in unit rents, which is now exceeding, Graeme, if we look at the slide for the growth in house rents over the past year, we can see that in Melbourne and Sydney, unit rents are now rising faster than house rents, and they're at around 20% per year growth. So that's amazing.
Wow.
To have that sort of growth in unit rents now. And I think that's the future going forward, is that those affordability barriers for that house rents for tenants, the tenants are starting to think, well, I can't afford a house, I'm going to have to get a unit, and they're starting to queue up for unit rentals in Sydney, Graeme, and it's also becoming a lot harder to rent a unit in Melbourne, which nonetheless still, as we can see when we look at the vacancy rates, Melbourne still has the highest vacancy rate for units, but it does continue to fall. And once we get below that sort of 2% mark for vacancy rates for units, which is still all about the CBD market, Graeme, then we'll know that we're really starting to soak up all those CBD units that have provided at least more choices for Melbourne tenants over the past couple of years, but not for much longer, I don't think. And you can see clearance rates there between houses and units are basically, similar. They're very, very low, and that's why we've got higher rents, or not just higher rents, but skyrocketing rents, Graeme.
Yeah, it's getting tough. But like I said, we've said previously, Doc, with all this migration, where are they going to live? Well, yes. Affordability, when you come to the country, skilled labour, you get your first job. It might not be your highest paying job when you first land, but obviously units are the affordability bucket. So, right. If it's a single, if it's a couple, they usually fit themselves into a unit, CBD or metropolitan, unless they have to go regional. They're usually going to save that $100 or $200 a week in picking a unit. Yep. So we're seeing units get a little bit out. It's quite interesting. I mean, if you look at a market like the Sunshine Coast, Gold Coast, parts of Brisbane, you're seeing unit rents exceed house rents.
Yeah.
That's insane.
Yeah. And look, a lot of that is holiday accommodation, I suppose, pushing those numbers up in those resort areas. But look, the underlying energy is clear that people can't afford houses anymore. So they have to look at what is typically the less expensive option, and that's a unit. And when we've seen the latest migration data, Graeme, as you alluded to there, coming out, and to some degree it was a bit of a shock. If we look at the latest the slide on the latest migration data, we can see and this is March quarter, which is the latest data, but nonetheless it shows a very sharp turnaround basically everywhere in net migration. So that's the difference between people coming and leaving a particular state, and that includes interstate and international migration. And we see big bounce back there in Victoria and New South Wales, which of course were flattened during COVID because they're the big international migration targets. They were flattened during COVID as a result of closed borders. But now our borders are open. We're seeing an absolute surge in migration. And I think it's interesting, Graeme, when we look at the slides which give us the breakdowns in terms of migration, breaking them down for overseas and interstate. When we look at the overseas situation, we can see that New South Wales and Victoria have just skyrocketed over the March quarter compared to the previous December quarter. So there's been
34,000 into New South Wales and 32,000
in one quarter. And, similar in Victoria. And that's just one quarter. And you can see how much, that's 3 times the number of people coming into those states compared to the previous quarter. So where are they going to live, mate?
Well, and this is the thing, Doc, for the doomsday. Where are these people going to live? It drives rents up again. It's people that can buy, that have come with money and sold overseas and trading internet. Yeah. There's more people in the workforce. These are skilled workers we're letting in. We've got a low unemployment rate. We've got not enough. Things are just going to keep going up. It's getting more competitive.
Well, that's right, Graeme. And I think it's also interesting that every state there recorded a sharp increase in net international migration over the March quarter compared to the December quarter. I was surprised at how strong those numbers were, just over one quarter. Now, we're into the December quarter now, Graeme. So it's actually backward looking, and we know there's an absolute flood of migration coming into this country already. In fact, there are reports that the government can't find enough workers to be actually process the visas. Applications. So I was like, oh, holy moly, there's a lot of people coming in here. So, no surprise, but it does, I guess, give us some real numbers to support the proposition that Australia's borders are down and we're open for business again in terms of migration. And I think the other point you made in terms of rents and migration is that it's not just the migrants that are coming in Australia with, migrant visas. It's also the students that are coming in with student visas. Now, they typically, as you suggested, would be looking for smaller unit smaller apartments in that CBD or close to the city areas where the colleges and the universities are. And that means that, even with those, I think that once that really ramps up, and the signs are that student visas are increasing sharply as well, I thought there might be a little bit of a blowback with students becoming more remote rather than on-site. But no, we're getting the on-site students, international on-site students coming back in. And I think we'll see those vacancy rates continue to fall in Melbourne and Sydney, particularly Melbourne, as students, come back into the education market. So, I think we're going to see a lot of continuing upward pressure on rents in those CBD areas in Melbourne, reflecting what's happening with the resurgence in students. Now, the other slide we have on migration, Graeme, which I think's again very interesting, and this is interstate migration. And we can see, of course, we're now in the period where, thankfully, we don't have the same focus on COVID. Lockdowns. Can you remember lockdowns, Graeme? Well, who'll ever forget them? Well, you didn't.
What? Sorry, a what?
Experience them, but Southerners, there were a lot of them who just thought, nah, not doing this, and they headed up into southeast Queensland. It was, of course, a key driver of skyrocketing prices in southeast Queensland, Gold Coast, Sunshine Coast, and Brisbane, where all those cashed up Southerners, looking for somewhere to live, looking to escape lockdowns. But no surprise if we can see there's been a huge fall in net interstate migration out of Victoria and New South Wales. No surprise. We've sort of seen the end of the COVID refugees over the quarter, if we look at the March quarter compared to the December quarter. But interestingly enough, that decline in the number of migrants coming out of New South Wales and Victoria is matched by an increase in the sense is matched by a decline in Queensland. So Queensland had nearly 20,000 over the December quarter net migration, interstate migration. And of course, as I said, there typically came from New South Wales and Victoria. But if we look into the March quarter, that's fallen right back down to just 11,000, Graeme. And that trend will obviously continue because we still were in the sort of the COVID issue of uncertainty over the March quarter this year. So there was still some, movement from the southern states up north. But I think that part of the reason we've seen the Brisbane market easing over the last month is they're no longer getting the jet fuel from interstate migration pushing up prices.
For sure. That's for sure.
All those cashed up Southerners are not coming in the floods that they were last year and pushing up house prices on the Gold Coast and Brisbane. But still, those prices are holding nonetheless at high levels, but they're not being accelerated by that international migration, those interstate migration levels. So I think that data is very interesting. And we also saw, which I think is interesting, Western Australia, its interstate migration levels, as we could see on the slide, Graeme, also fell significantly because there was also a movement across to the west during the COVID period as some from the east were perceiving that it was a bit of a safe haven. So certainly had some interesting data today, Graeme. Some big news in regard to the interest rates, and everything seems to be sort of panning out reasonably well at the moment, particularly given the circumstances of all the negativity we've had to deal with over the last 3 or 4 months.
I agree. We've got to be Teflon and make sure none of that negativity sticks. So, Doc, just in wrapping up today, bit of a viewer question, not specifically, but a dialogue I had over the last few days with somebody who's a client. And they were talking about, they'd seen the CoreLogic data set, which I put up on Facebook the other day for September. They're going, and they were struggling to comprehend. And I had a little post on it, but we've got $9.7 trillion of residential property in Australia and only $2.1 trillion of debt. So they were struggling to understand that if only, 22% of our residential market actually has debt, they're scratching their head saying, well, these rate increases aren't really affecting the majority of the market. It's only a smaller portion.
That's right.
Also, obviously, you've got consumer debt. So car loans, you can't borrow as much for a car maybe, or a holiday or a personal loan. But can you just give some insight, Doc, into why the knee-jerk reaction to, inflation and all these sorts of things is interest rates. Well, even though it's, it's only 22% of the market, why is it that the RBA says, well, we need to increase rates to help reduce spending? What's the economical policy or thought process around that? Because the logical everyday person says, well, if it affected 70% of the population, you get a really quick result. But if the data says only 30% of people are affected, how does that help us?
Well, what the Reserve Bank is trying to do is to reduce demand, Graeme, and they reduce demand by obviously taking money out of your pocket if you're a mortgage holder. But it is about creating, unfortunately, higher unemployment. I mean, that's the offset here. It's the devil or the deep blue sea. Do we have inflation or do we have higher unemployment? Well, the perceptions are, and there's probably a very solid case. Well, there is a very solid case that we don't want galloping inflation. That is, almost impossible to control once we get higher wages chasing higher prices that then chase higher wages. You find it very difficult to stop that. And in fact, if we go back to the 70s and the 80s, it took a best part of 10 years and the 90s to control sort of out of control inflation. So it can be a bit of a journey. And the unfortunate thing is there's a lot of grief through that journey because people lose their jobs. I mean, we can all be sitting back now thinking, gee, life's pretty cool, and whinging and whining about higher interest rates. But, we had a recession in 91, Graeme, where we had, over double figure unemployment rates. And some states or some capitals, such as Melbourne, had unemployment rates, around 12 or 13%. That's a very, very sobering statistic. And when you get that amount of people in work, you're actually destroying lives, mate. It's not just, we've controlled inflation. Well, yeah, but you've actually destroyed lives in doing it and livelihood. That was a very tough period of time. So it's a delicate balancing act. And I think that's what the Reserve Bank's doing now is they're just starting to say, okay, let's not get out of control here. Things aren't too bad. Let's wait for the next set of data to determine if we need to go a little higher, or maybe we'll just throttle back on the brake a little bit now and without having to risk pushing us into some sort of an economic downturn, which is clearly where the US and the UK seem to be headed at the moment. So ticks to the Reserve Bank. They're looking at us rather than just following the pack overseas. But we've still got some way to go here, Graeme. But nonetheless, when we do talk about debt and interest rates and the impact that it has on it, the key statistic is always the level of arrears and defaults on mortgages. That shows us where the real stress is. And if we do start to see higher levels of defaults and arrears in mortgages, we know that higher rates are biting against the capacity of people to repay. And that typically, of course, happens when people lose their jobs. So we're not in that realm at all. The whole point is that part of what we're bidding up in terms of our wages at the moment reflects, us trying to match and cover our balance sheets. But I think Australians are doing pretty good, Graeme, to be quite honest.
Yeah, we're neither of us are a fan of the negativity, Doc. I think we just look at the data and trust in the numbers. And like you said, but we are getting on with it. Aussies are resilient by nature. So a lot, there are a small percentage of people that are acting or enacting on the clickbait, but I think majority of Aussies are just getting on with it. And we'll continue
that's right,
to.
Graeme. And I think the strong economy here is the key. That's the real key. These are numbers we've never really seen before in terms of unemployment rates. And everybody knows out there, if they've got, mates, relatives, acquaintances, that are all getting big or getting, wage rises at the moment and moving on to another job. And, you got to feel pretty good about those circumstances, notwithstanding the unfortunate impact that may have on inflation going forward. But that's up to the Reserve Bank to control.
Absolutely. Well, thanks, Doc, as always. Extremely valuable, and we will catch up again next week.
Yeah, it's been a big week, hasn't it, Graeme? So
it has indeed. I'm excited.
We can talk about next week.
Yeah, well, things aren't as bad as they seem. I think we're going to see this changing dialogue now. The narrative's changing, so it'd be good to start talking about some positivity.
That really was an interesting decision by the Reserve Bank.
It was indeed
0.5%. That really does validate what you just said, I think, Graeme.
Absolutely, Doc. Look forward to catching up next week.
Mate.
Thanks, Doc. Bye. Well, there we have it, ladies and gentlemen. Brilliant and informative from Doc Wilson, as always, and sometimes not too bad myself. Hopefully you found that extremely informative. And for those of you who are tuning in regularly, don't forget to check the show notes. And if you are looking for a bit more financial education and financial literacy, and you'd love to spend 2 days with people like myself and Doc Wilson and chartered accountants, etc., I encourage you to go to money-mentor.com.au. And I'd love for you to be able to use the discount code podcast1500. That's podcast1500. And you'd be able to spend 2 days with people like Doc and myself. That's usually $2,000. It'll be just $497. So have a look at the show notes, ladies and gentlemen. Look forward to seeing you soon.